The capital raising environment has largely changed over the last 12 to 18 months in a massive way. Back during 21, 22, it was easy to raise money. Interest rates were incredibly low. The Fed was printing a lot of money. It just created this environment where a lot of people were flocking to alternative investments, mainly in commercial real estate. Well, what happened after the rug got pulled out as a direct result of the historic run-up in interest rates, the interest in commercial real estate investing really started to fall off a cliff. People weren't making a quick buck like they were at the peak of the last market cycle. When we got into 2022, 2023, we started to see a bottoming out in that market cycle, right? And so we had a lot of apprehension coming from investors because they were either losing money with other operators or there were some deals that had suspended distributions. And so it really caused this freeze up in the capital markets. What separates sponsors that are still raising capital today versus operators that are sitting on the sidelines, it really comes down to a brand identity issue. A number of operators that have had some troublesome times over the course of the last several years are struggling raising the equity right now because of the fact that they weren't over communicative with their investor base during the times of those headwinds. They didn't put their investors' interests before their own when times started to get tough. Quite frankly, there's a lot of operators that are on the sidelines right now because they don't feel like they can raise the equity that they would need to take a new asset down because of that brand challenge that they have on their hands. In today's capital environment, transparency is everything. Is that operator willing to give you a glimpse behind the curtain? Are they willing to answer the tough questions? Having an operator that's willing to give investors full access to the financials, the underwriting, the balance sheet, the income statement, the general ledger, giving investors access to the same accounting entries that the senior lender is requiring access to. And so it's really that level of transparency that you as an investor or a capital partner are looking from an operator before you choose to decide to partner with them. One mistake that I see a lot of new sponsors making is they're chasing after the shiny new asset class. So you might have an operator that starts in multifamily value add class C, and all of a sudden the next deal they're raising capital for a retail investment or a self-storage or industrial or flex office. The important thing for investors to understand is the operator themselves vertically integrated across the platform? Do they have a local infrastructure with boots on the ground in that market capable of supporting the asset? Are they sticking to their core fundamentals of what they know they can rinse and repeat and execute deal after deal after deal? What most investors are concerned with right now is their portfolio diversified enough? Am I too heavy in Wall Street right now? Or maybe am I too heavy in alternative investments? At some point, stocks don't always go up and to the right. They also go through periods of retraction. They also go through times where there's a correction, right? You really need to recognize that now may be a time to start to transition some of your Wall Street holdings into alternative investments, because now is a great time to get involved when property valuations are down. Alternative real estate investing is really not much different than investing in stocks, right? You're looking to buy low and you're looking to sell high over the course of that investment hold period. The advice that I would give to capital raisers in this environment right now is you have to continue to nurture relationships with your existing investors and find a way to increase the size of that funnel. Make new connections, ask for referrals. It's really important to do that because at some point the market is going to turn. And when the market does start to turn, you want to make sure that you're in a position to be able to capitalize on those opportunities. Now is the time for people to get involved in investing. So yes, it's very difficult right now to raise money, but that's also usually a time that's the best time to get involved. Even though it's hard to raise $50,000 or $100,000 from an investor right now, if you successfully place that capital into an investment opportunity in 2026, it's likely to perform better than that capital that was placed at the peak of the last market cycle back in 21 and 22, for example.